If you've ever hesitated to check your credit score out of fear that looking at it would make it drop, or if you've intentionally left a small balance on your credit card thinking it builds your score faster, you are not alone. The financial world is full of half-truths, outdated advice, and straight-up urban legends. But when it comes to your credit, acting on the wrong advice isn't just inconvenient. It can cost you thousands of dollars in higher interest rates, lower loan limits, or even outright rejections when you apply for a house or a car. Experian is one of the 3 major credit bureaus, and every year, millions of people try to game their Experian score using methods that actually hurt them instead of helping them. Today, we are pulling back the curtain on the most common credit score myths once and for all, addressing the real mechanics of how credit works and giving you exact, actionable steps to build a high score safely. Here is how it actually works. There are 2 distinct types of credit inquiries: soft inquiries and hard inquiries. A soft inquiry happens whenever you check your own score, whether through the Experian app, your bank's online portal, or a free credit monitoring service. Soft inquiries also happen when a company runs a background check for employment or when a credit card company pre-screens you for an offer. Soft inquiries have 0 impact on your credit score. A hard inquiry, on the other hand, happens when you officially apply for new credit, like a mortgage, an auto loan, or a new credit card, and the lender pulls your report to make a lending decision. Hard inquiries can temporarily drop your score by a few points. This brings us to the second, and perhaps most expensive myth: you need to carry a balance on your credit card to build credit. This myth is a classic. Somewhere along the line, people started believing that if you pay off your credit card completely every month, the credit bureau thinks you aren't using the card, so they won't give you credit points. People end up leaving a $50 or $100 balance on their card every month, willingly paying 20% or 25% interest to credit card companies for no reason. Let's be crystal clear. Carrying a balance does not help your credit score. It only costs you money and interest. For example, if you have a credit card with a $1,000 limit and your statement balance is $200, your utilization is 20%. When your statement generates, that 20% is reported to Experian. That is what builds your payment and utilization history. Now, let's talk about what happens when you finally pay off a debt. Myth number 3, closing an old credit card after paying it off will boost your score. It feels natural, right? You work hard to pay off a credit card, and you think, I'm done with this. Let me close the account so I don't get into debt again. Doing this can actually cause your score to drop significantly. Why? Because of 2 major factors in the credit scoring formula: total available credit and average age of accounts. First, when you close a credit card, you instantly wipe out that card's credit limit from your total available pool. If you have 2 cards with $5,000 limits, $10,000 total, and you carry a $2,000 balance on one, your total utilization is 20%, $2,000 out of $10,000. Second, credit scoring models reward a long history of responsible credit management. The older your accounts, the better. Closing your oldest credit card eventually removes that account's history from your report, shortening your average account age. Unless a card has an outrageously high annual fee that you can't justify, keep your paid-off, no-fee credit cards open. Put a tiny recurring charge on them, like a streaming subscription, and set up autopay so the card stays active without risking late fees. Myth number 4 revolves around income. If I make more money, my Experian credit score will automatically go up. Your credit report is purely a measure of how reliably you handle borrowed money, not how much money you earn. A person making $30,000 a year who pays every bill on time and keeps their utilization low can easily have an 800 credit score, while a high earner making $200,000 a year who maxes out cards and misses payments can have a score in the 500s. Now, does income matter at all? Yes, but only to lenders, not to your credit score. When you apply for a loan, a bank will ask for your income to calculate your debt-to-income ratio to make sure you can afford the monthly payments. Myth number 5, you have just one universal credit score. People often say, my score is a 720. But in reality, you don't have one score, you have dozens. First of all, Experian is just one of the three main nationwide credit bureaus in the United States, along with Equifax and TransUnion. Not all lenders report to all three bureaus, meaning your report with Experian might differ slightly from Equifax or TransUnion. Second, there are different scoring models. The most common are FICO Score and Vantage Score. Even within FICO, there is FICO Score 8, FICO Score 9, FICO Auto Score for car loans, and FICO Bank Card Score for credit cards. Finally, myth number 6. If you mess up your credit once, it takes decades to fix. More importantly, the impact of negative items fades over time long before they actually fall off. A late payment from 4 years ago carries far less weight today than a late payment from last month. If your credit is damaged, you don't have to wait 7 years to see improvement. By taking actionable steps today, you can start rebuilding momentum in as little as 6 to 12 months. Here is your foolproof 4-step framework. Set up autopay for minimums. Payment history makes up the largest portion of your score. A single 30-day late payment can drop a good score significantly. Set every account to automatically pay at least the minimum due date every month to ensure you never miss a deadline by accident. Keep utilization below 10%. While 30% is often cited as the maximum recommended threshold, people with top-tier scores, 800 plus, typically keep their overall utilization under 10%. Pay down your credit card balances before your official statement closing date to keep reported utilization low. Keep old accounts open. Maintain your oldest credit lines to preserve your average length of credit history. Credit isn't a secret club, and it isn't a game designed to trap you once you know the real rules. Stop relying on financial myths, focus on the core fundamentals of on-time payments and low utilization, and let time do the rest.